Hey, this is Lon Welsh at Ironton Capital, and today we're going to talk about how to retire early with passive income. So, the goal here is to work smarter and not harder. So, you probably have an idea of how much cash you need to have to be able to retire with your lifestyle, and what I hope we'll be able to show you is a way to be able to do that with millions less than you initially thought. That probably sounds great, I'd imagine. So, have you ever wondered what it'd be like to wake up in the morning with all the time to do what you want rather than what you need to do because your investments are making returns on autopilot? You're about to discover our formula and what our clients use to retire earlier. So I hope that by the time we finish here today, you'll know everything about how we at Ironton retire earlier with passive investing so you can work smarter and not harder. Too many investors are making decisions based on what they hear on CNBC or the coffee shop. They're not aware of the advantages available to accredited investors, and they're trying to build their retirement the hard way. It's not your fault. After putting in long hours at your career and your business, very few of you guys have the time to do all this research, so we're happy to do all of it for you. So, what is passive investing? It's simply a way to take yourself from managing contractors and renters or managing a portfolio of stocks that you pick to just depositing checks based on my 20 years of real estate experience, and my two colleagues on the investment committee also have worked for 20 years each. But we'll talk about that a little bit more in a moment. So I'm going to show you some case studies and hard data today. None of that is to be interpreted as a claim of income, implied or otherwise. So a little letter here from our attorney. There's some confidential information in the presentation. It's mostly for you to be able to share with your financial advisor, your CPA, your attorney, and anybody else on your financial team. Investing in real estate involves risk. This presentation is not any kind of an offering of an investment opportunity. If you find anything interesting from an investment standpoint, we would love to share the legal docs with you. Most importantly, the private placement memorandum. It has all the risks spelled out in a lot of detail and all the specifics about how the fund operates. And then you and your financial team can go through that in depth. We'll have some forward-looking statements, and you'll hear words like may, will, should, plan, expect, seek, anticipate, believe, estimate, aim. These are all based on our best estimates, and that's what they are, estimates. Company sourced information, some of it's from us, some is from our sponsors, some is from our analysis of what's going on in the market. You'll want to do your own analysis to draw your own conclusions. So with the legal formalities out of the way, your results are up to you, and I can't predict them, but we'll try to do the best that we can. So here's the investment team at Ironton. Brent Geyer is our CEO. He's got over 25 years of real estate acquisition, development, and land use experience, and his analyzed return over his lifetime is over a 20% IRR, internal rate of return. Richard Landry was at Goldman Sachs and built large portfolios there, and then he was also the chief investment officer of a $2 billion family office before joining us. Lots of experience there. I worked in strategy consulting for 8 years at Deloitte and Accenture after a time in corporate finance. And I've been in commercial real estate since then for about 20 years. And one of the things that I think has helped me out the most is I built from scratch the largest real estate brokerage in Colorado, Your Castle Real Estate. So we have a little over 750 agents. We do a little over 5,000 deals a year. So usually in an atypical year, 1,000 or 800 of those transactions will be for investors or commercial. So I've had a front row seat for 20 years with hundreds of transactions each year to be able to say, is that going to work? Is that not going to work? What assumptions did you make? Did that work out the way that you planned? And I've learned so much by watching all these deals with a front row seat over all these decades. So that really informs a lot of what I do here. So the fastest and most predictable path to financial security and growth is through passive investing. Because if you could put your investments on autopilot, you're on your way to true freedom. And that's really great if you can set this up in a relatively short amount of time. So the ultimate mission today is to help you to be able to do that quickly and consistently. And because knowledge is power, I'm going to try to give you as much information as I can. So historically, you've probably heard about the 4% rule or maybe the 4.5% rule. So to generate $1 a year and have it be inflation adjusted over your retirement, you'd need to have about $25 in savings. So the math is just you take the $25 in savings times 4%, it generates $1 worth of cash you can spend. And there'll be a little bit left over that gets reinvested. So next year, you don't get $1, you get maybe $1.03. And the next year after that, you get $1.07. So the dollar is going to scale up with the pace of inflation over time so that your purchasing power in retirement doesn't get diminished. And the goal is that you'll never run out of savings this way. So whatever $25 you're starting out with, maybe it's $35 by the time you pass away and this goes to your children. The goal is that they'll get the whole amount of money. We're not depleting it any. So let's imagine that you want to have a $300,000 retirement income, and you've got two earners making $45,000 each from Social Security, and you've got maybe $10,000 in a pension. So the gap remaining to fill is $200,000 a year. So if we divide it by this traditional 4% return metric, you would have to have $5 million in savings right now to generate your retirement. This is actually how I got into real estate, because I did this math when I got out of grad school. My wife was getting out of medical school, and I thought, my God, that's a lot of money to save after tax. Is there a better way? And the answer is yes. So where does this 4% come from? Well, the answer is that if you take a look at the really long-term average of a traditional stock and bond portfolio, over the long haul, the stock and bond portfolio will generate somewhere between 7 and 8%. Inflation is usually around 3 or 4%. So if you take the expected return of your stock and bond portfolio, subtract inflation, that's where the 4% comes from. So if you invest in something else, this is how you figure out the safe withdrawal rate that will also preserve your purchasing power from inflation over time. So imagine that you put it into our real estate fund, our long-term growth fund. Our goal is to make 17 to 20% per year. And you could subtract 4%. I'm going to say 13% after the inflation. That would be a much faster amount of money you could draw out than the 4% would be. So for many of you, a good answer would be, and of course talk to your financial planner and your CPA, I'm not a financial planner, is to maybe have half your savings in a diversified stock and bond fund like you have now, half in a diversified real estate fund, and you'd probably be able to make around a 13% blended return per year. If you take out 3% for inflation, that's a 10% that you get to spend. So with a $2 million savings account with a 10% return, you can pull out the $200,000 per year. And the extra return, because we're expecting a 13% return, we'll reinvest. So the next year you get $206,000. So it accounts for the inflation. So the goal here is to come up with a way for you to enjoy that extra income, the $200,000, but only have to have $2 million in savings instead of $5 million in savings. And with that change, maybe you can retire 5 or 10 years sooner, or maybe you retire on the same day, but you'll have more money available. Either way, it leads to a better lifestyle. So compounding interest is a concept is not well understood by a lot of people. So I want to try to explain that for you here to help you wrap your brain around it a little bit. So in the upper left-hand corner, let's imagine you've got a savings account. It delivers 4%, and you invest $1 million on day one. If you take a look in the upper left where it says savings, if you look at the bottom of that graph, you see it goes from 0 to 25 years. So at the end of the 5th year, your $1 million savings account at 4% a year will grow to $1.27 million. And by the end of 25 years, your savings account will have grown to $2.77 million. So not too bad. However, if you look at the purchasing power of this, if we assume that it was 3% appreciation, 3% inflation each year, and you took out the impact of inflation, you would see that that savings account would only grow from $1 million to $1.3 million over a 25-year period. So the 4% savings account isn't really enough to keep up with inflation and deliver anything extra beyond that. So if you look in the upper right, this is our traditional stock and bond portfolio, delivers about 8.5% historically. So your $1 million investment today in 5 years is worth $1.63 million. And if you go out for 25 years, it goes to $8.3 million, which is phenomenal. And this is why stocks and bonds have been the gold standard for people investing for, a century or longer. So if you take out the impact of the inflation and do it in today's dollars, your $1 million investment over 25 years in stocks and bonds will grow to $4 million, which is still absolutely phenomenal. There's nothing wrong with stocks and bonds, and I think any financial planner would tell you that no matter what you do, you're probably going to have a big part of your foundation investment in stocks and bonds, and I think that's great too. In the lower left, we've got MTI. That's our medium-term income fund, and it'll pay somewhere between 11 and 13% per year, and that's paid quarterly. The amount that it pays depends on the amount you have invested with us. So the more you invest, the more you get paid. So your $1 million investment today in 5 years grows to just under $2 million, and by the 25-year mark, it grows up to $19 million. So if you pull out the factor of the inflation, that $1 million investment would have $9.4 million of purchasing in today's dollars. So for some of you, blending a little bit of MTI into your overall portfolio might be really attractive. Where I usually see people really gravitate towards this is if you're an active landlord today. Let's say you've got a 10-unit apartment building and you're just tired of being a landlord, and you want to get rid of the building. But you are spending the cash flow from that building to supplement your lifestyle. So when you sell the building, some of your proceeds we could put into MTI, the medium-term income fund, to replace the income that you're losing when you sell the building. And for a lot of people, it's a way to level out their lifestyle, not have to take a cash hit when they finally get off the treadmill of being an active landlord. Then the final option we'll explore is on the lower right. This is the National Diversified Fund, NDF. This is our long-term investment vehicle, and our goal with this is a 17 to 20% return. So for you today, I modeled this on 17%. Your $1 million investment today in 5 years would be worth about $2.57 million. And after 25 years, it'd be worth about $59 million. So the compounding interest on a larger number like 17% is absolutely mind-boggling what it does. If you were to take out the impact of inflation, you'd have about $30 million of purchasing power in today's dollars. So for that active investor selling their 10-unit apartment building, some of the proceeds they'll often decide they want to put into the long-term fund to complement the investment that they make in the medium-term fund. When you think about the 10-unit building, they've often had it for a long time, and it's had a lot of compounding interest of appreciation. They may have bought the building for $500,000 20 years ago, and maybe it's worth $2.5 million today. From $500,000 to $2.5 million, we can replicate that kind of growth for you with the NDF part of our portfolio. So each of you will have a slightly different set of needs, and if you like, what I can do, if you're an active investor, is we just need to get a couple details about the building or buildings you're thinking about selling, and I can model for you, if you continued to run it as an active investor as you have over the next 10 years, what sort of wealth would that generate for your family? If you sold it and paid some capital gains taxes and put it in the stock market, how would that perform? Or if you did the medium-term income or our National Diversified Fund, how would those perform over 10 years? And if I do that for you, then you'll have all the facts that you and your family need to make a fully informed investment decision about how to grow your wealth. And we're very happy to do that analysis, and we do lots and lots of those. So Google tells me that Albert Einstein is the person who said, compound interest is the eighth wonder of the world. The man who understands it collects it, and the one who doesn't pays it. So very true. So this chart is the exact same information I showed you. It just shows you all four of the lines on one graph, so you can more easily compare them. So the blue line on the top is our National Diversified Fund. The green line in the middle is our Medium-Term Income Fund. The orange line near the bottom is that typical stock and bond portfolio. And then the bottom line is the savings account that gets 4% interest. So you can get a good sense of how these two investment vehicles outperform the traditional stock and bond portfolio. So I was hinting a minute ago about how I could do that analysis for you if you're an active landlord. Of course, we work with lots of people who aren't active landlords as well. But this is a sample of the analysis that we do for those of you who are landlords today. This is an example I did a couple weeks ago of a gentleman who owns a duplex. He has about $184,000 of equity. He's currently making about a 9% return, so just about the same as a stock and bond fund. And we would project over the next decade his $180,000 of equity would grow to $430,000, which is not shabby, not bad at all. So if you were to sell it, this is the column just a little bit to the left. He'd have some transaction costs, he'd have some capital gains taxes. We would modify that to reflect your unique situation. And then the leftover amount, $149,000, would grow to about $720,000 over 10 years. So in this particular case, it made sense for him to sell that duplex and invest with us. That won't always be the case, however. We're happy to do the math to help you figure that out. And then you can share it with your financial planner and your CPA. So we've been doing this for a while. We've done over 20 funds over the years, and you can kind of see how we've done over time. The original internal rate of return estimate, and then the current estimate, or the actual that we achieved. And all these are net of all fees. So this is what you actually got to deposit into your savings account. So a couple quotes from investors. Justin said I had a goal of how much I wanted to generate in passive income from all of my hard work owning a small business. And he also had a lot of rental properties. And he's been able to develop a portfolio now with us that has helped him to actually exceed his passive income requirement, which has been nice. He's no longer an active landlord, and he's actually bought a very nice home in Portugal, which he's enjoying greatly. Jared mentioned that he had a 15-month period where he had 4 tenants not renew their leases, and they all left the place in bad shape. And although he's still an active investor, he's reduced his workload a lot by selling off some of his rentals and investing passively with us. He says it feels really good to have time back with his family, and it's much easier and a lot less stress for him. And similarly for John as well. I'm very grateful for all these guys that they provided us with these wonderful quotes. So imagine a picture of this. You're finally able to get your time back. Time to relax, time to enjoy quality time with people who matter while your portfolio grows on autopilot, because we're managing it for you. So I want that for you as well. So let me ask you, did we provide value for you today? Would you like to get some insight into what you might have been missing, not knowing a lot about passive real estate before you were on this webinar today? So to participate, you need to meet just one of these 3 criteria. If you're single with a household income over $200,000, if you are in a double income household with income over $300,000, or if your investable assets are over $1 million, not counting your primary residence. Any one of those 3 things, you're an accredited investor and we can work with you. Now, Congress recently did give direction to the SEC, the Security and Exchange Commission, our regulator, saying they would like for non-accredited investors to have the ability to also participate in funds like ours. So we're waiting to see what that rule set is going to be from the SEC. We expect that you'll have to take some sort of a test just to show that you've got a basic level of financial literacy. And if you pass the test, then you'll be able to invest. So stay tuned with the media. Hopefully we'll see some announcements on that coming up soon. Where can you get the cash to do this? You could just use cash. You could use a self-directed IRA. That's actually a very, very common strategy. If you've got an investment property with a really low mortgage and it doesn't make sense to refinance and you want to hold on to that project for a little while longer, let me know. I can refer you to some banks that can do a line of credit or a second mortgage on your investment property to access some cash, and that'd be a tax-free event that you can invest with us or anything else that you want. Or there's other options. So giving back, I'm on the board of directors for the Boys and Girls Club and the Denver Zoo and Ronald McDonald House, and I've donated a lot of money to them, and I'm excited to donate a lot more in the future as we have success together. So you can book a time with anybody on the investor relations team or me by going to irontoncapital.com/book-now. Something I didn't mention that I should bring up is that I wrote a book recently on passive investing, and it also talks about how private equity funds like us work and how we're similar to or different from the stock and bond portfolios that you might have currently at Vanguard or Fidelity. So I'm happy to get a copy of that to you for free as well. So set up that appointment with, on the Book Now site and mention, hey, I'd love to get a copy of the book, and we'll get that to you so you can have that as a resource. It's a really quick read. Thank you so much for your time today, and I hope I get to talk to you soon.